I'll quote the
Thanks
great
for being the guinea pig.
the great Mike Tyson. Everybody's got a plan until you get punched in the face.
strategy.
There's strategy. Because there's a part of me, there's an emotional part of me, and I hope this would resonate with somebody out there, where it's like, this makes total logical sense. Because I want income, 85% of my portfolio, dividend. Let's take a sliver of our portfolio, 5, 10, 15, whatever percent you can afford, and let's go chase some real growth. All right, guys, we're going to have a fun discussion today. So there's a strategy, this portfolio type that's floating around the internet right now in a lot of different circles called, it's got a catchy name. It's called Barbell. All right. Now, the premise of this is kind of simple. You know, you put the lion's share of the portfolio in something relatively safe and conservative.
Yeah.
And on the end, you do something a little crazy. Okay. Which we're going to dig in a little bit. The problem with it is, well, we need to figure out what the problem is. Does it really work? Is it something worthwhile? And that's what we're going to kind of discuss today.
Yep.
So in the circles that you guys are running in online, are you seeing this?
No.
You said you're not.
No, I'm literally like, what?
Yeah.
Full transparency. I was like, what are we talking about?
Come on, man.
I must not be online very much.
Definitely not looking for barbell.
No. Well, different types of barbells.
Well,
the weight training ones.
Well, before we jump in, let's make sure you subscribe to the show.
Mm-hmm.
All right, so let's talk about the myth versus reality. So where did this thing come from? Where did the barbell come from?
Like, I think a guy named Nassim Taleb, I think is the...
Is he a friend of yours?
No, he's not, but that's the guy who gets the credit for coming up with the original
What was the
idea.
original thought?
I think his original thought was, 85% of your portfolio is like in cash and treasuries. Keep it really safe. You have the safe money, and then the other 15%, he would do what he called the crash-proof investment, like a covered call or something in the options, so that because he was famous for timing markets before
And he didn't
the
really
crashes.
time them. He was just prepared.
He was prepared for the black swan event.
Yeah.
And so that 15% was supposedly that crash-proof.
And here's a guy who's like ultra conservative. At least the portfolio design was ultra conservative. It was in like, money market cash type of things, T-bills, something super ultra conservative.
Yeah.
And then he had these like, okay, what if events, if things go bad, we're going to profit.
Right.
And it's a little bit of the percentage of the portfolio, like 15%.
Mm-hmm.
So 85% is sitting in safe, places. 15% could hit big if something bad happens. But you're like, that 15% is dead, not doing anything unless that black swan happens.
Right.
The 85% is making you a little bit of money.
Sit around.
So when the market's crushing it, nobody knows about this guy. And then all of a sudden, the event happens. And then this guy rises, to fame. He's like, oh, look what I did. I was the most brilliant investor out there. I timed this perfectly. He didn't.
It's the guy.
It was the design.
Yeah.
It wasn't the time.
Like the guy, timed the housing market crash and all that. Where,
for
years he had been
the Big Short.
Yes, he'd been shorting, and then finally, it hit.
What's the problem in this portfolio design? Is there a problem?
Well, it sounds like it's just a strategy to adopt without really. Is this even what I need? What if you need more than 85%?
Before we're going to get into that in a little bit. Before we get into that, let's just back up and look at the market as a whole. If you look at the market in a 10-year increments, how often does the market go up in 10 years?
It's about 80% of the time.
80%, 8 out of 10 times.
Yep.
So 8 years out of every 10, the market's going up 2 times, 2 years in every 10. This is an average.
Yeah.
But historically, if you look at blocks of the market, it's an 80-20.
Yeah.
So there's always been exceptions. I understand that. And there's been times where it's been 60-40.
Right.
Like in 2000, 2001, 2002, 2008.
The
You had 4 years,
Mm-hmm.
And the market went down, but that was the anomaly. But everybody remembers it.
Sure.
Because it was in the last 2 decades. So this design on how it was originally constructed was not very favorable. Made some guy famous because, he was sitting in a portfolio design like this in the 1 year and everyone was like, oh, I want that. I don't want to hurt. Forget about making money 8 of the 10 years. Right. Just don't lose me money when the market goes down. And unfortunately, I think that we're designed that way.
Yeah.
So we're drawn to a design like this that's only successful 20% of the time.
And the other time it's like, just don't lose money when the
and
market's
everybody
doing
else
well.
is soaring.
It's soaring, yeah.
and you're just like you're
kind of putzing along.
not even putzing along. I mean, you're muted.
Yeah,
You
I
know,
mean, if it's
nothing's
just in
happening.
T-bills. It's like, whoa.
Right.
Yeah, which is garbage. Now the design has changed though.
Yes.
It is not in this original design anymore. And here's where the
But they're
kind
still
of
calling
problem-
it the same thing,
It's
right?
still the same. It's still this
Okay.
like flashy
Yeah.
barbell. So they've replaced the middle. It is no longer conservative. Now it's what? What have they replaced it with?
On each end?
No,
No,
the middle.
the actual the grip, the 85%.
They went from T-bills and cash accounts to what are they putting? in? Something that we love.
Yep. Dividend
Some
income.
Dividend. They replaced the conservative with dividends. So like the lion's share of this portfolio is something that we actually can get behind. And this is where it can get a little attractive. You know, for somebody like us, we're like, let's put 85% in solid rock star dividend stocks.
Mm-hmm.
And then let's replace the black swan events on the outside with, if the market goes down, you know, we can make money with what do they replace it with?
Well, now they're doing things instead of like using options. They're like saying, "How about crypto or other speculative investments?"
So it's getting really off the rails here.
So
Yeah.
the original design is no longer, which didn't really make sense. The original design, like there's a part of this portfolio design, the original design, that's attractive to people just because of, what do they call that? Something aversion.
No, risk
Risk
aversion.
aversion.
Yeah.
Where it's like,
Yeah.
I don't care if you don't make me money, but don't you dare
Don't
lose me
lose
money.
Exactly.
Yeah.
You know, and that until everybody's making money.
Right.
And
then
then
they're
you're like,
like,
why
"Why
aren't
am I
you
not
making
making-"
money?
Yeah.
You just told me, you know, like we should do a short on that because that would, you know. that could
But
be
markets
some
are
money.
efficient. Emotions don't drive anything.
Yeah, no,
Yeah.
nobody's emotional.
Yeah.
When they're sitting in my office,
Money
they're
and
very
emotion
logical.
completely separate.
Yeah. What are we talking about here?
No offense to anybody else.
Yeah.
Hey, we're the same way.
Yeah. We're speaking from experience.
Yeah.
So, but now they've completely changed the design, and now it's dividends on the middle, and then we've gone crazy on the outside. So now it's not even a risk aversion portfolio.
But it's like, I feel like with options and stuff, like you can strategically purchase those in ways where if the market goes down, those are going up.
Correct.
Or you can at least create some
you
profit.
can hope.
Correct. But crypto has no rhyme or reason to
No.
anything that it does really attached to the market. It
No.
moves at its own complete space.
Mm-hmm.
And just because the market, the general market, is going down or going up does not mean that crypto is going to move in the inverse.
No, and it can have wild swings on its own. Yeah.
Oh yeah, I
Mhm.
mean for sure, just kind of independently. But just because the U.S. stock market's going down doesn't mean everyone's fleeing to crypto to save their.
That doesn't work that way. And
No.
typically,
Yeah.
dividend stocks do very well when the market goes down. So it's almost like, hey, let's put the bedrock of this portfolio in something that handles relatively well when the market's up, is a rock star when the markets go down, and let's just throw flyers on the end. And there's a part of this that's like, ooh, like this
Yeah.
is attractive, you know,
Mhm.
because especially if you're
What
really good
what
on
if
the
they hit?
barbell. Yeah.
What if they hit?
So, but let's table that for a second.
Yeah.
Because we're going to come back to that. Let's
Yeah.
play a new game called Defend Your Take.
Uh-huh.
So I need somebody to dig in a little bit. And I
Okay.
want you to come up with a take of the barbell that makes sense to you. And then we're going to challenge you on it. So who wants to defend their take?
It's a clever framework that they're using here to try
barbell.
The barbell. Uh-huh. But I think it's using the term is trying to sell something that really isn't anymore. And one of my concerns is that, you know, like if you're looking at like people that we deal with a lot of times who are either near or in retirement, if you got $1 million portfolio and someone's advising them to say, well, maybe they're already in dividends. Let's just say you got $1 million portfolio paying you income because you're nearing retirement or in retirement. And then you're going to slice off 15% of that suddenly and put it in something like crypto. Well, how's that going to affect how does that affect the person right off the top? You're already cutting off some of their income, slicing off a piece of that cash flow to put it in something that might work or might not work for them long term. So what are they actually buying? How is that actually helping them? And how is it serving them for their retirement long term?
So I'll play
Mhm.
the devil's advocate against that.
Uh-huh.
What if, let's just assume I didn't need that 15%. Why would I not gamble with that money to make more than what dividends could make?
Well, yeah, I guess that's the question. What is it actually doing for you? To
The 15%?
Yeah, what is it doing?
Well, you better pick right.
Yeah.
Well, and I mean, you kind of went very specific, not to,
Mhm.
jump on him too
No,
hard.
go ahead.
It's like, we're
No.
gonna tag team on
Yeah,
it.
man. Come on.
But you talked specifically about the people in retirement. We deal with people in all different ages and people who are just starting to invest. To put, so much into these safe, I think the frameworks can be great, because it's like, hey, we can consistently grow it through some dividend, but then let's go for these flyers that could really get you way ahead.
So I guess
since you have time.
Yeah, I think that's a fair point, because depending on
No. There's no fair point on that. You're digging.
You gotta fight back. Yeah.
No, I think there's some fair points, but in retirement,
defend your take, man.
I am defending it. But on that 15% too, that it could also, if it goes the other way, it could harm somebody that is in that retirement where maybe
but I got time. I'm 40.
60.
I got time.
No, but I'm saying,
And I'm not an emotional investor. I can handle volatility.
It's only 15%.
Yeah, for the younger investor, sure. But I'm just talking with the older investor, that could be more costly.
Well, what I would say on this is, and I'll quote the
Thanks
great
for being the guinea pig.
the great Mike Tyson. Everybody's got a plan until you get punched in the
strategy.
face.
Yeah.
There's
Yeah.
strategy.
No, but
That's what I'm
saying,
trying to
like
say.
the strategy.
Mike Tyson, yeah.
I hate
Well,
whenever it's like
but it's
one
true.
size fits all. Like, just do the strategy and it'll all work out. And it's like, well, that's not my situation.
Well, and here's
man.
where we're going to turn this conversation, because there's a part of me, there's an emotional part of me, and I hope this would resonate with somebody out there, where it's like, this makes total logical sense, because I want income, 85% of my portfolio, dividend. I get a little bit of growth, a lot of growth. We got some rock star, and we're crushing the
absolutely.
market. You can have a little bit or a lot of growth depending on the year, and you can satisfy an income need. Let's take a sliver of our portfolio, 5, 10, 15, whatever percent you can afford, and let's go chase some real growth without income. And the logic behind that is, let's go crush the market.
Yeah.
Okay? Everybody's got a plan until you get punched in the face. Because what happens when nothing's happening in the market and that 15% gets crushed?
Yeah.
What happens when something happens to the market and dividends are doing well and that 15% gets crushed? We're just assuming the plan's actually going to execute and work well, but we all know, I mean, I've been in this business for almost 30 years now, and I can tell you every great idea that either a portfolio manager's had. I don't want to be so bold to say that I've come up with some great ideas, but at the end of the day, most of these great plans, most of them have not, if it was that easy, we'd all be rich. We just go, okay, this is what we're going to do. Everybody would figure out the formula and we'd all implement it and there'd be no worries. But that it doesn't work that way.
Right.
So we're going to, let's go from this kind of cutesy, cool idea and talk about real planning. Let's talk about simplicity. Let's talk about understanding your shortfall. Let's talk about identifying investments out there like dividends that can satisfy your need. Because at the end of the day, you have to start with, what do I need to produce? How hard do my investments have to work? Don't step back and go, what do I want?
Well,
Step back and go, what do I need?
You can't start with a solution.
Right.
And I think that's where this is coming in. Like, you're starting with a solution, but you don't even know what your problem is.
We haven't backed up and said,
It's taking your car to the shop and saying, hey, I need new brakes. And they're like, you don't need new brakes. You need new rotors. You need new wheels.
You need a new car.
Like brake lines. You're leaking fluid everywhere.
Or you're like, I need new brakes, new whatever. And they're like, your car's fine. Right. Like, let's just say somebody who's all in dividends, like, well, no, I need to sell some of that. It's not doing anything. Case in point, we had a position in our portfolio last year that was killing. Like, it did so bad, and y'all know what that position is. It did so bad. I got pressured so many times to get rid of it. And the client's going, it's a black eye. Why is this in our portfolio? And, fast forward a little bit of time, and you get to a point as a portfolio manager where it's down so bad, and you look at the books and you're like, hey, we've got time. Let's just be a little patient here.
Right.
But there are I had clients literally demand, like, get that out of my portfolio. I'm sick of seeing the red in my portfolio in that one position. It is by far and away the best position in our current portfolio.
Yes.
Like, I mean, rushing it.
Yep.
Pulling up almost the entire portfolio. You say, well, we're getting back what we lost. No. Because what happened is, when the position that's a strong stock company is losing value for whatever reason, and you're reinvesting, you're buying, you're compounding. You could say you're compounding your problem, or you could also say you're compounding your opportunity for rebound. And that's exactly what happened.
Right.
And I'm not going to say I knew this was going to happen.
But story matters with
Yeah.
what's happening in the company. I think you're making a good
Yeah.
point.
Yeah. And that's
It
what
was-
we're talking about here, where sometimes, you know, you can have bad things happen in the market or your portfolio, and it's just a loss. Or sometimes you're positioning yourself or repositioning yourself to rebound heavily. With the barbell, there's nothing. We don't even know, like crypto, like what's the strength of the company? Oh, wait, there's no company.
Right.
What's their revenue?
Yeah.
Oh, wait.
There's no
They don't
revenue.
even have any.
Where's the, what backs the, oh, wait, there's nothing backing it.
Right.
Yeah.
Like specifically with crypto. And
Right.
you can like look at precious metals.
Mhm.
You know, we're not even on precious metal standard in the United States. Is anybody backed by gold and in the world? I don't think
I
so.
don't think so. Yeah.
So at the end of the day, like we can logically push ourselves into these cool designs, these fatty designs. But if we don't understand our own shortfall and need, and then solve our income portfolio around that, if you have surplus, we can have a discussion.
Absolutely.
But why would my total bias is going to come out of here? But why would I diversify out of investments I know work well in good times and bad times? They have income. We call about the tether.
Yep.
You're tethered to these positions because they pay. And we saw earlier in this year where the market got crushed. All markets, every single market in America this year was down at different times.
Yep.
And the dividend stocks have been up since day one.
Yep.
So,
And why? Because they had tether. They paid income. They had great earnings, good companies, and strong return.
and when you have crazy volatility for no real reason other than just macroeconomics, where are you going to go if you're an asset manager where you can get some guaranteed positive return, which is a dividend?
It's a safe haven.
It is.
It's not it's not guaranteed cash. You know, there's a lot of things that can go wrong in dividends, as we saw with a lot of positions in our portfolio over time. But at the end of the day, these are strong companies with great free cash flow.
Yeah.
Yep.
They tend to rebound very, very well. Sometimes the market just pulls them all down. And that's another thing. We've talked about it on the show all the time. How does this stock, whether it's a growth stock or dividend stock, how does the stock ever lose value when it's always profitable? Like my brain can't even comprehend that.
Right.
had record profits, and it sinks by 3%
Because it wasn't
today,
as much record as we were expecting, you know, like
expecting 53 cents per share, and you got 52 and a half.
there's mad manipulation going on in the market.
There
at
is,
times.
yeah.
All right, so let's land this plane. What's the takeaway?
I think it's interesting, but I think for us, how we plan, how we educate clients and prospects, you got to start with your shortfall, establish a plan, and then see what fits that. You can't start with a solution in mind at the beginning.
Right.
Well, there's a
That's
lot
the
of
cart before the
practice.
horse. Yeah.
Right.
What are you gonna say there,
I
Mr.
said that
Todd?
would be
Come on, Bama.
malpractice, starting a solution without knowing what your problem is.
The first part of that again?
Malpractice.
Oh, malpractice. I thought you were gonna bring in some Saban analogy or something.
Yeah, what would Saban do?
Just be where your feet are.
You heard it first.
I heard
Or second. You heard it second. Anything else?
No, I think that's right.
I think for me, I think we've discussed a lot, but at the end of the day, check out the Dividend Starter Kit. It's a great place to start in understanding a lot about dividends, and really most importantly, understanding your shortfall, like backing up to go forward. Because I think you nailed it. Like there's so much about this barbell that is super attractive. Like even for a guy like me who's been in this business a long time, I've seen a lot of things. There's like, should we redesign things? No. What we do works very, very well.
Stay with the tried and true.
Yeah. I
You
wanna
say
dig-
tried or tied?
Todd. The Todd and
Tried and true. Go balls.
Hopefully you've learned a lot today. This has been a fun discussion. Thank you all for being a part of this, and God bless.